So let's look at how trade policies and geopolitical events shape stock market trends. How trade policies and geopolitical events, how do they influence stock market trends? Number one here is an introduction. You know, so trade policies and geopolitical events are what we are considering in this video. So we need to highlight their significance in shaping global economic conditions and investor sentiments. So number two is trade policies and stock markets. Trade policies and stock markets. So you have tariffs and trade barriers. Tariffs and trade barriers. These are examples of trade policies. It's a typical example of the U.S.-China trade war, and it caused volatility, in technology as well as a manufacturing sector. So industry reliant on global supply chain are particularly, vulnerable. During the past Trump administration, there was this U.S.-China trade war. It discovered that the technology and manufacturing sectors were negatively, impacted because of this reliance on, on global supply chains and, actually. So there's free trade agreements. Free trade agreements. So it provides a kind of positive impact. So in this case, it boosts exports, and stock prices will grow as, in export-oriented sectors. So trade agreements generally boost exports, and sectors related to this this area would benefit maximally, benefit positively. Example is NAFTA or its successor, the USMCA on North American companies. These are factors that will then go a long way in determining stock market trend. Then there's protectionism. Apart from tariff and barrier and trade barriers, what is called protectionism. So where the government implement policies that are designed to protect local industries from foreign competitors. So beneficial benefits for domestic industries, but may hurt, multinational corporations. You discover that domestic, companies will benefit because of that lack of competition from foreign firms, but it certainly hurts, multinational, corporations. Example is steel and aluminum tariff. It benefited, U.S. producers, but there was a rising cost for auto manufacturers, for auto, car companies. Number three is geopolitical events and stock markets. Geopolitical events. We've just considered how our trade policies affect the markets. We want to look at how geopolitical events affect the stock markets. So in this case, we want to look at, want to consider political instability. Political instability. In this case, effects of elections, of leadership changes, or political turmoil, on local and global markets. Example is Brexit. Brexit prolonged uncertainty, which actually, impacted European and UK markets. That was a popular geopolitical event. So you have wars and conflicts. Wars and conflicts. In this case, energy prices often spike during a supply concern. A typical example of what happened during the Gulf War. During Gulf War, and even the early part of the Russia-Ukraine war, it affected energy prices. So defense stocks may rise during periods of heightened military activities. Defense contractors may benefit. Stocks in those sectors will then benefit. Whereas global oil price is down, and the energy sector may be impacted negatively. Let's look at global alliances and sanctions. These are all, this is a typical example of geopolitical events. Global alliances and sanctions. Sanctions on countries or companies can disrupt markets. Example, Russia's economic sanction, affecting energy market during the, the early parts of the Ukraine war. There was sanction on Russian energy sector, and that impacted global oil prices. So in the case of shifts in alliances, example, NATO expansion may impact regional markets, will impact regional markets. Number 4 is sector-specific impacts. Sector-specific impacts. Let's consider the technology sector. This sector is sensitive to export restrictions and intellectual property policies. When it comes to export restrictions, you discover that it will impact the technology sector significantly. Let's consider the energy sector. This sector is strongly affected by Middle Eastern, geopolitics and OPEC decisions. Whenever OPEC come together to decide on whether to restrict, oil production or to expand production, the outcome always affects the energy sector. So let's look at the agricultural sector. It depends on trade agreement and export bans. Trade agreement, ban on exports and even imports could impact agricultural sector. Number 5 is long-term versus short-term, effects. Long-term versus short-term effects. Short-term volatility from surprise announcements. Generally, whenever there's a surprise announcement, either from the central bank or geopolitical events being announced, or trade policies will affect the stock markets, will bring in volatility. It may be on a short-term basis anyway. So long-term trends influenced by policy outcomes and geopolitical resolutions. Generally, when government undertakes resolutions, discover that it will influence the markets. Number 6, how investors can respond. That's the most important part. How do you respond to all these geopolitical changes and trade policies? So you diversify your portfolio to mitigate risk from one specific region or sectors. You diversify across sectors and also diversify across regions so that a negative occurrence in a particular region or sector will not affect your overall portfolio. So you use safe haven assets like gold or government bonds during periods of uncertainty. So you monitor development through reliable news sources and economic reports. You have to keep your ears down and monitor news from your news feed. Thank God in this day and age you get things almost regularly on a timely basis. So you monitor them and see how you could react proactively. In conclusion, summarize the interconnection, of trade policy, geopolitics, geopolitics and the stock markets. So you need to take proactive, decisions so as to be able to mitigate the impacts of these, factors on your portfolio, or to be able to determine how it will shape, stock market trends in the future. So you adapt to them and you make necessary changes.